Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, back in 2025, France quietly executed this massive financial maneuver.
Yeah, massive.
Right. And it involved 129 tons of gold that was just sitting in a New York vault. And I mean, on the surface, it sounds like the plot of a Hollywood heist movie, you know?
You immediately picture like armored trucks and heavy security.
Exactly, yeah. Giant cargo ships loaded with heavy metal crossing the Atlantic Ocean under the cover of darkness.
Yeah.
But according to recent analysis of central bank movements, there were no armored trucks.
Nope, no boats either.
Yeah, no boats. The gold never actually moved across the Atlantic. So today, for this deep dive, we're looking at why the biggest financial players in the world are, fundamentally changing how they manage their wealth.
And I think, more importantly, what everyday American investors can actually learn from those moves.
Right, because it is a fascinating maneuver to pull apart. When most people think about central banks, the mental image is usually, some shadowy committee printing money.
Yeah, or setting interest rates behind closed doors. We rarely think of them as active portfolio managers.
Right, but they are. I mean, they hold trillions of dollars in assets just to keep their country's economy stable.
Exactly. And how they manage those assets, specifically, the physical logistics of them, has massive implications.
And based on the data we are looking at today, the focus for these central banks isn't necessarily on hoarding more and more gold.
Which is what you might assume during uncertain times.
Right, totally. The focus is actually on changing how and where they keep it.
And that is the subtle but really crucial distinction. In the world of high finance, the how and the where aren't just administrative details.
Right.
They are variables that can literally mean the difference between, billions of dollars in profit or a massive crippling liability on a national balance sheet.
Wow. Okay, so let's get into the mechanics of this so-called heist.
Let's do it.
According to the official announcement from the Banque de France, this was back in April 2026, they pulled 129 tons of gold out of the Federal Reserve in New York.
Right.
But you just said they didn't put it on a ship.
They didn't. Between July 2025 and January 2026, the Banque de France realized that their gold stored in New York was essentially what the industry calls non-standard.
Non-standard, okay.
Yeah. So to solve this, they didn't refine the gold and transport it. They simply sold that non-standard gold right there in the New York market.
Oh, I see.
Then they took the cash in that sale, hopped over to the European markets, bought the exact same amount of highly standardized modern gold bars, and just placed those new bars in a vault in Paris.
But wait, I mean, isn't gold just gold?
You'd think so, right?
Yeah, if you melt it down, it's all the exact same element on the periodic table. Why does the central bank care if a bar is non-standard, if it's just going to, sit in a dark vault for another 50 years anyway?
It's a great question. And it really comes down to the mechanics of global trading. In financial markets, gold is not just gold.
Okay.
The global standard is known as London Good Delivery.
London Good Delivery.
Right. These are very specific bars. They weigh exactly 400 troy ounces, and they must have a purity of at least 99.5%.
Wow, okay, so very strict rules.
Incredibly strict. They have to be cast by certified refiners and hold specific serial numbers.
So what was sitting in New York then?
Well, it was a historical hodgepodge. I mean, you have to remember how central banks accumulated gold over the 20th century.
Right, over decades and decades.
Exactly. Some of it was melted down from old coins, some of it was cast in different eras with different weights, and some of it had varying levels of purity.
Oh, so it's basically a mixed bag.
A huge mixed bag. If France ever needed to sell that old gold in an emergency, buyers would demand a massive discount.
Because they'd have to process it.
Right. They would say, well, we have to test this, we have to assay it, we have to melt it down and recast it into good delivery bars, and that takes time.
And costs millions of dollars, I'd imagine.
Exactly.
Yeah.
By swapping it out, France eliminated all of that friction. Their total gold stash hasn't changed by a single ounce.
Which remains exactly at 2,437 tons, right?
Yep, exactly.
Yeah.
But the quality and liquidity of that stash have been drastically upgraded.
It's like prepping for a cross-country move. Let's say you own a vintage, clunky car, and it's sitting in a garage 3 states away.
Right. And instead of paying thousands of dollars to tow a car that you can't even find replacement parts for.
Yeah, you just sell the vintage car right where it sits, take the cash, and buy a modern, reliable daily driver right in your own hometown.
That is the exact mechanism at play here. Standardized gold is just much easier to value on a balance sheet.
Makes sense.
It is immediately acceptable as collateral if the country needs to borrow money on short notice.
Right, because everyone agrees on exactly what it is and what it's worth.
Exactly. In fact, this modernization process is so critical that recent reports show the Banque de France plans to upgrade another 134 tons of old bars and coins that are currently sitting in Paris by the year 2028.
Wow, so it is a massive financial housekeeping project.
Huge.
So the math makes perfect sense, but the average citizen in Paris or Berlin isn't looking at the Banque de France's balance sheet.
No, they definitely aren't.
They are looking at the news, and you don't move 129 tons of national wealth without people talking.
You certainly don't.
Yeah.
And I think that brings us to the tension between political optics and financial realities.
Right. And just to give you, the listener, the political context here, and we are just looking neutrally at the media reports from the time to understand the landscape. In May 2025, European media, specifically in Germany, sparked some pretty intense debates.
Oh, yeah, it was a huge talking point.
The conversation really centered around whether the United States, under current President Trump, remains a reliable trade and security partner for Europe. With shifting global alliances and, new tariff discussions, many European citizens viewed moving the gold back home as basically taking back local control.
Yeah, it was heavily framed as a geopolitical statement of independence.
Exactly.
But the official stance completely separates from that public narrative. François Villeroy de Galhau, who was the governor of the Banque de France, explicitly denied any political motives whatsoever.
Really? He just flat out denied it.
Flat out. He drew a firm line, stating this was purely a practical market-driven decision. High-standard gold trades primarily in European markets, so logically the physical asset belongs in Europe to avoid future transport costs.
Okay, I have to push back a little there. I mean, is it ever just practical?
Fair point.
This is international central banking. They know exactly how a move like this will be perceived by the public and by other nations.
You're definitely right to be skeptical.
Yeah.
But the internal accounting numbers actually back up the central bank's claim in a way that is really hard to argue with.
Oh, really? What do the numbers say?
There is a stunning financial detail in the research regarding this swap. By selling the gold in New York and repurchasing it in Europe, the Banque de France executed an absolute masterstroke of accounting.
Okay, how so?
They locked in a massive 12.8 billion euro one-time gain.
Wait, slow down.
Yeah.
If I have a $10 bill from 1990, it's still worth exactly $10 today.
Right.
If I swap it for two $5 bills, I don't magically make a profit. How does selling an asset and buying the exact same amount of it result in a 12 billion euro gain?
Because central banks don't use the same accounting rules that you and I use for the cash in our wallets.
Well, of course they don't.
Right. They use something called historical cost accounting for their reserves. Let's use a real estate analogy to make it simpler.
Okay, let's hear it.
Imagine you bought a house in 1970 for $40,000.
Okay, a nice, cheap 1970s house.
Exactly. Now today, let's say that house is worth $1 million. But under historical cost accounting, until you actually sell that house, your official books still say you only hold a $40,000 asset.
Oh, wow. So the profit is just unrealized, basically.
Exactly. It's invisible on the balance sheet. Central banks have held some of these gold reserves for decades.
Right.
So the gold in New York was sitting on their books at a very old, much lower historical price.
Oh, I see. So the only way to make that profit real on paper is to trigger a sale?
Precisely. By selling the gold in the current New York market, they realized the profit, meaning it went from a theoretical, invisible gain to an actual taxable profit on their balance sheet.
That is wild.
And the timing of this was not an accident. The Banque de France was facing a massive budget deficit at the time.
Oh, how convenient.
Right. By realizing the 12.8 billion euro gain through this swap, they managed to turn what was a 7.7 billion euro loss in 2024 into an 8.1 billion euro net profit for 2025.
So it was essentially a genius accounting loophole to fix a multi-billion euro hole in their budget.
Well, loophole might be a strong word, but it was incredibly strategic. If we look strictly at the data and the outcome, it was primarily a balance sheet victory.
Makes sense.
They needed to fix a deficit, and they found a way to do it while simultaneously upgrading the physical quality of their assets.
That is just brilliant.
It is. That being said, central bankers aren't blind to public opinion. The political optics of, bringing the gold home played incredibly well with a European public that was anxious about global stability,
Sure.
even if the primary driver was just exceptionally good math.
Hey, you get to fix your national budget and look like a patriot at the exact same time. It's a win-win.
Exactly.
But France isn't acting in a vacuum here. To really understand what this means for the global economy, we need to zoom out a bit.
Yeah, we do.
How is the rest of the global chessboard reacting right now?
Well, the broader global shift is undeniable, and it points to a very defensive posture. According to an April 8 Reuters survey, 70% of central banks now view geopolitics as their absolute #1 risk.
70%, that's huge. And when they say geopolitics, they mean the risk of wars, disrupting supply chains, sudden trade tariffs, economic sanctions, basically the breakdown of the normal rules of international trade.
Exactly. Now, interestingly, despite those fears, the U.S. dollar is still viewed as the ultimate safe haven by 80% of these central banks.
Okay, so the dollar is still king.
It remains the bedrock of global trade, absolutely. But at the very same time, 40% of them are actively planning to increase their physical gold reserves.
Wow, that is a massive percentage. So let me make sure I have this right. They still trust the dollar for their day-to-day operations, but they want the gold as a backup parachute just in case the system freezes up.
That's a great way to frame it. And China is the clearest example of this dual strategy in action.
What are they doing?
The data shows that China's central bank bought gold for 17 consecutive months, leading up to March 2026.
17 months straight.
Straight. And the key detail here is that they didn't stop when prices dropped or fluctuated. They are treating gold as a structural safety net.
Right. They aren't trying to time the market like a retail day trader flipping tech stocks.
No, not at all. They are building a permanent foundation under their economy to insulate themselves from future global shocks.
Which brings up a really confusing point about how everyday people view gold.
Oh, the price action.
Yeah. The assumption is always, when the world gets crazy, gold goes up.
Right.
But looking at the latest data from April 13th, 2026, things were definitely crazy. Oil crossed $100 a barrel. U.S.-Iran negotiations were breaking down. There were fears of naval blockades.
It was a tense week.
Yeah. You'd think gold would be skyrocketing, yet it didn't.
It didn't. In fact, if we connect this to the underlying mechanics of the market, on that exact day, despite all that headline-grabbing geopolitical chaos, gold prices actually dropped 0.6% to $4,719 an ounce.
Why? I mean, explain the mechanics of that, because to an American beginner, that feels entirely backwards. If there is panic in the Middle East and oil is spiking, shouldn't investors be fleeing to gold?
You would think so, but gold isn't a magic shield that exists outside of normal economics. It is locked in a constant tug-of-war with two major forces:
Okay, what are they?
the strength of the U.S. dollar and the yield on government bonds.
Let's break those down one by one. How does the dollar pull gold down?
So globally, gold is priced in U.S. dollars. It's an inverse relationship. On April 13, because of all that global panic, international investors actually flooded into the U.S. dollar looking for safety.
Okay.
And that made the dollar very strong. When the dollar is strong, it takes fewer dollars to buy the same ounce of gold. So the price of gold, measured in dollars, mathematically has to drop.
Okay, that makes sense. It's just a currency conversion thing.
Exactly.
And what about the government bonds?
This one is about opportunity cost. Gold is just a shiny rock, right? It doesn't pay a dividend.
Right.
It doesn't pay interest. It just sits in a vault. Now, if global panic causes the Federal Reserve to keep interest rates high to fight off inflation from that $100 oil, then U.S. government bonds are going to pay a very high guaranteed return. Let's say a Treasury bond is paying 5% interest.
Okay, so if I'm a massive institutional investor, I basically have a choice.
Right.
I can hold gold, which pays me nothing and actually costs money to store.
Yep.
Or I can hold a U.S. government bond, which is equally safe but pays me a guaranteed 5% every single year.
Exactly. When bond yields are high and the dollar is strong, large investors will actually pull money out of gold to chase those guaranteed returns.
Even during a geopolitical crisis.
Even then, the opportunity cost of holding a zero-yield asset just becomes too high.
Wow, that is a vital nuance. It's not just the simple equation of, crisis equals higher gold prices.
Not at all. Which brings us right back to why France's move was so strategically brilliant. They weren't making a speculative bet that gold prices would just keep going up forever. They understand these mechanics. They were simply taking the physical asset they already owned and making sure it was in the best possible location and in the highest possible quality.
So it could serve as usable collateral regardless of what the spot price did on any given Tuesday.
Exactly.
So you're probably listening to this thinking, great, France fixed a multi-billion euro national deficit with literal tons of gold, and China is playing 3D chess with global reserves. But I am just an everyday American trying to fund my 401k and build a decent savings account.
Right. It feels very disconnected.
Yeah. So how do you translate these massive macroeconomic central bank moves into actionable advice for a normal person?
Well, the underlying math and the strategic principles apply directly to personal finance.
Okay.
The research actually gives us three very clear lessons that apply just as much to a household budget as they do to a national reserve.
I love this. What's the first one?
The first is the concept of quality and custody. As France demonstrated, it's not just about what you own, but how you own it and where it is located.
Meaning, is your wealth actually usable when you need it most?
Precisely. France realized their non-standard gold in New York was a logistical headache that would penalize them in an emergency.
Right.
For an everyday investor, you have to look at your own safety nets. Is your emergency fund locked up in a 5-year certificate of deposits that takes weeks to break and charges heavy penalties for early withdrawal?
Oh, that's a great point.
Yeah. Or is your wealth tied up in a complicated illiquid asset like real estate that takes months to sell? Or do you have highly liquid standardized cash equivalents that you can access on a Sunday night if your roof caves in?
Let's make this concrete for our listeners. It's kind of like prepping for a hurricane.
Okay, I like that.
Let's say you want to make sure you have enough water for your family when the storm hits. You could go out and buy a giant 100-gallon industrial water tank and bury it in a concrete bunker in your backyard.
And technically, on a spreadsheet, you possess the water.
Right. But good luck prying open that bunker and punking it out while the storm is actually raging. That is the old non-standard gold.
Exactly. What you actually want is a bunch of manageable, standardized 24 packs of water bottles sitting right on the shelf in your pantry where you can easily grab them in the dark.
Yep. That is the high standard liquid gold. It's entirely about access and usability during friction.
That leads perfectly into the second lesson for the retail investor, the dollar plus gold combo.
Okay, how does that work for us?
Well, remember the central bank survey data. 80% still view the dollar as the ultimate safe haven, but 40% are adding gold.
Right.
The takeaway here isn't that fiat currency is dying. You don't need to empty your bank account, buy a bunch of gold coins, and bury them in the woods.
Please don't do that. Your mortgage company does not accept gold doubloons.
Right. Even the most powerful central banks see it as a partnership. You absolutely need dollar liquidity for everyday moves, paying the mortgage, buying groceries, handling immediate life expenses.
So the dollar is your working capital.
Exactly.
Yeah.
But having a small structural hedge, whether that is gold or real estate or other stable, uncorrelated assets, can protect your overall portfolio against unknown inflation or market shocks.
So it's about finding a balance, not treating your finances as an all-or-nothing binary choice.
Yes.
And what's the third lesson we can pull from the Banque de France?
Active management.
Yeah.
France didn't just let their gold sit collecting dust for another 50 years just because of tradition.
Right. They actually did something about it.
They looked critically at their balance sheet, saw a 7.7 billion euro deficit, and actively used the assets they already had to fix the problem.
Wow.
They swapped old for new, realized a massive historical profit, and fundamentally strengthened their financial position without actually spending any new money.
So the lesson is don't just set it and forget it forever.
Yes. Everyday investors should periodically review their portfolios. Are your assets working efficiently for you? Are you holding onto an underperforming stock or a high-fee mutual fund just out of habit?
Right. When selling it and reinvesting in a simple, low-cost index fund could put you in a much stronger position.
Exactly. You have to audit your own financial setup.
It's a great actually open smoothly when you pull the cord, not get tangled up in administrative red tape.
And that is the true genius of what the Banque de France did. They didn't buy a new parachute. They just made absolutely sure the one they had was packed perfectly.
Man, that is a great way to put it. So, as we wrap up today's deep dive into the surprisingly cinematic world of central bank reserves, I want to leave you with a final thought to mull over.
Right.
We've seen how France optimized their holdings to fix their balance sheet, and how China is steadily building a massive physical safety net month after month.
Yeah.
If the most powerful, data-rich financial institutions in the world are currently obsessing not over how much wealth they have, but where it is physically located and how quickly they can cash it in without friction. What invisible global risks are they preparing for that everyday investors might be completely ignoring?
Wow. It definitely forces you to look at your own financial readiness in a whole new light. If the central banks are preparing for friction, we probably should be too.
It really does. Don't forget to subscribe and hit that like button.